Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend Podcast. It may have been a chilly January outside in much of the country, but you know what wasn't cold? U.S. inflation. The consumer price index rose by more than forecast across the board in January on a monthly and annual basis, as did the core measures, which strip out food and energy costs. And with employers also adding 350,000 jobs last month, again, exceeding all estimates, well, that has led to some rethinking when the Fed is going to cut rates this year. That said, we also got data that supports those thinking about the Fed cutting rates sooner than later. U.S. retail sales broadly declined in January, the biggest drop in nearly a year. Treasury Secretary Janet Yellen this past week shared her comments on the CPI, saying that she still sees continued progress in bringing inflation down, though she did address one of the more worrying components of the report, shelter costs. Today on the program, we take a step back to focus on everything real estate, from apartments bought with cash in New York City to commercial real estate, student housing, storage units, and more. So let us begin by taking a moment to think about your life, thinking about your daily routine and the built environment that you interact with, your office or workspace, the roads, the parks, public transit, all of the infrastructure that's around you, and equally important, what you find on the other side of the doorways that you walk through. Maybe it's just me, but these things have a huge effect on my life and my well-being. For our next guests, this is their world. Andy Cohen and Diane Hoskins are the co-CEOs of the privately held global architecture, design, and planning firm Gensler. Gensler has more than 50 locations and 6,000 employees around the world, in the Americas, Europe, Greater China, Asia Pacific, and the Middle East. Gensler does more than $2 billion a year in revenue and counts 80% of the top 50 Fortune 500 companies as clients. Terminal 1 at JFK, NVIDIA's corporate headquarters in Silicon Valley, Shanghai Tower, the tallest building in China, M&T Bank Stadium in Baltimore. These are among the thousands of Gensler projects around the world. Andy Cohen and Diane Hoskins are also the co-authors of a new book. It's called Design for a Radically Changing World. They joined us in our New York City studio.
We're in a world where new cities are being created, I won't say overnight, but, again, at such a rapid pace. We were just in India, and, to see the kind of energy and excitement going on and the transformation that we're part of as a design firm in Bangalore. We were just in Mexico City, hearing a lot about the nearshoring and the energy that that's bringing to the economy there, and obviously opportunities in the built environment as well. So, again, as a global firm, we're part of this transformation that is literally happening, around the world. We were at COP28 and in Dubai, and, again, all of what's happening in the Middle East. So, the United States, there's amazing things happening that hopefully we'll talk about as our cities are finding their path. But we're very bullish.
Well, safe to say we have a sensitivity about cities too, and we think it's really important that if you have healthy cities, you have healthy countries and healthy policies. Like, it kind of starts at that level. But I want to dig a little bit deeper, Andy, because you guys do have this incredible global perspective. Any signs that there are companies or cities slowing down on projects because of uncertainty about what's to come?
Again, like Diane said, we have this global perspective. We worked in over 100 countries last year. We're seeing the U.S. right now, definitely in the work sector, in the office sector, definitely slowing down. We're in 4 sectors in our firm. We have work, lifestyle, what we call cities, and health and wellness. We're seeing our work sector definitely being hit right now with the slowdown in office, although we're doing a ton of office to residential conversions right now.
Are you really?
A ton of those right now.
Go ahead.
Like
old office buildings?
Older office buildings. What we're seeing is, because office buildings right now, they're only 50% occupied. We're seeing this unbelievable flight to quality that's going on right now, where tenants really only want to be in highly amenitized quality buildings that are brand new or newer.
Right.
And the older building stock, millions upon millions of square feet, what we call B and C product, or B and C buildings, are really, really problematic. So what we have done, we created an algorithm recently that we're able to study entire cities or whole portfolios of buildings and analyze them quickly to see which buildings can be converted from office to resi. And about 25% of the building stock in the United States and around the globe can be converted.
Diana, I mean, we've heard for years since the pandemic that, it's just too expensive to convert on a large scale old office buildings into housing. I mean, think about it from the perspective of the plumbing, and there's some lack of windows. I mean, how do you do this efficiently? Is it something that is realistic to do to offices that aren't used?
Yeah, as Andy said, we've created a tool where we can answer that question really quickly.
So some buildings it works and some buildings it doesn't.
What's in that tool? What is it?
No, it's, we've put together basically a way of bringing all the analytics that would probably take, a pretty extended period of time to study into a very concise set of metrics that predict the viability of an office building becoming residential. So the window to the core, that dimension. Obviously, super deep apartments are not going to work.
Right.
The floor to floor height. Again, there are ideal floor to floor heights for residential that are different in many cases than office. The loading dock, by the way, makes a huge difference. What's going on with, the column bays. So all of this, basically we do a scoring, and literally if it's 80 or above, it's viable. If it's below, maybe not so much.
And you said that algorithm says 25% can be reworked, which makes me think that other 75%, do you think ultimately it's just going to have to be either torn down or done away with?
Well, we're doing a lot of adaptive reuses right now to other types of uses, but definitely the reason why we're studying residential is there's such a shortage of residential. And so we need more residential, and this is a sustainable way of doing it. Instead of ripping a building down, we can reuse the building, which is so much better for the environment. I should also add, Diana and I just went this morning, we saw a project called the Pearl House, and it's here in Lower Manhattan. It's the first unbelievable successful conversion from office to resi, and it was a building built in 1970, and we were able to literally turn it inside out and turn it from a standard office building into residential, and we think it's going to be a home run here in New York.
It's really cool to hear about this,
great to
because
hear that,
again, it's like we've been talking about this for years, and it's like it's good to finally see this happening. So Diane, how susceptible is Gensler to blips in the economy? Because the reason I ask, and I don't think it's an obvious answer, is because yes, a big portion of your revenue does come from offices, but also a lot comes from municipalities. You do airports, courthouse renovations, parliament. So how much of that is dependent on fluctuations within the global economy?
Yeah, over the last 20 years where we've been co-CEOs, we've really focused on diversification and really looking at all of the kind of a 360 from, as Andy said, sort of this work sector, which we've been talking about. That's the office buildings and then the spaces inside those buildings. But even that is like, you've got tech and you've got financial services and, professional services. But, right now, one of our fastest growing practice areas is actually aviation. And, you look at the stimulus, the, infrastructure bill that got passed not that long ago, you're starting to see amazing projects going on all over the U.S. in terms of these, much needed new terminals. We all go, overseas and see great terminals, but we're starting to see some amazing opportunities here in the U.S. So, again, that diversification, whether it's another massive growth area for us, is sports stadiums. And, again, we all saw the Super Bowl, but, it's so important in our communities to, entertainment and sports as well. So, and let's say hospitality. I mean, again, since COVID, we all know the hospitality sector has been just on a rocket, and that reflects also back into the work that we're doing.
I want to go right to one called social and racial justice, because I think about how we have done in general housing for decades and kind of separating lower income, and then developers, maybe they throw a few units. Like, how do we do, and Diane, let me start with you, how do we do this better?
Yeah, it's about equity, right? For so many years, and in so many of our cities, there are communities that just haven't had the investment. And so, at Gensler, we're really being mindful about seeking out opportunities to work on projects that are helping to create more livable streets, more green space, helping to create schools that are exciting children to want to learn and grow. But
for not just one member of the social strata, correct?
Yeah, exactly.
For everyone.
For everyone. And it is about equity, and how do we bring that through design?
Andy, you and Diane argue that design can be a more powerful tool than policy when it comes to changing cities for the better. Explain.
Well, sure. I think first let's talk about the context. For the first time in human history, more people live in cities than not. 55% of the world's population lives in cities. And by 2050, 70% of the world's population lives in cities. So the design of cities are obviously going to be really important for the global population. And we believe, and this has to do with policies moving forward, we believe in the philosophy, and through our research, of a 20-minute city. And the 20-minute city, and we learned this through COVID, is that everything is walkable. Everything you need in life, every amenity that you need in life is walkable. Grocery stores, restaurants, retail, healthcare, education is all within a walkable district. Now, in a small city, that would be 20 minutes. In a city like New York, you would have multiple 20-minute cities. But this philosophy of access and amenities, even having to do with racial justice, is the idea that you have these amenities at your fingertips, and about that design can make a difference in our world.
How do you make sure it's affordable amenities that are within everybody's reach? Because that maybe is not always, I don't know if that's within design, capabilities, or is it? Like, how do you work that in as well?
Again, at the end of the day, design isn't about the price tag. It's about the decisions that we make as designers. Where to put, the green space, where to put, instead of a wall, maybe it's shrubbery, or maybe it's the way that you move from one space to the other instead of something that's very rigid and kind of onerous. It's about experience. And, at the end of the day, design is about 1,000 different choices we make with the design problem. And again, I go back to, it's what we focus on. It's what we focus on. Design is for every neighborhood in a city.
But are clients all sensitive to that? I mean, I do always wonder, especially if it's a tougher economic environment, right? Tim and I constantly, here we are going through earnings still, and it's, the bottom line, and, what gets a stock moving. It's a buyback sometimes, or a dividend, or cost cuts. In these, thank you, Mark Zuckerberg, the year of efficiency continues for many. So Andy, come on in on this. Like, when you guys are working on a project, how important is it that it's access for most? How do you incorporate climate change aspects? How do you do it? Make it greener, make it better?
For our clients, they're looking for it all. They want
Are
to
they really?
They want to make sure that it's equitable, but they also want to make sure that it's financial. And so we're constantly balancing the two. And I'll talk about housing for a second. We do a lot of housing, and much of the housing today, on every project, 10 to 20% is affordable housing. That's being factored into the perform of
Is that
projects.
More than has been in the past?
Absolutely.
Okay.
Most projects, residential projects, would have zero affordable. And now, based on the demographics of the community, developers are building that into their perform and make it work. And that gives us the ability to create equality in design, to make sure that design's for everyone.
Diane, Andy mentioned climate change, and curious how you design in a world where extreme weather events are happening more frequently, beyond just putting everything on stilts, because that's certainly one way to do it. But is that like the only option for low-lying environments, or even Lower Manhattan, or Red Hook in Brooklyn?
Or do you not develop?
Well, look, you put your finger on probably the most critical issue of our time, which is climate change. And this is impacting all aspects of the built environment. 40% of global emissions and CO2 are from buildings.
Yeah.
I mean, it's a huge issue. It's both how we make the buildings,
We've
the
talked about
concrete and steel and
We've
all of
talked about that a lot here.
So this whole idea of adaptive reuse, That's really literally, we can cut in half the amount of emissions from our buildings if we can reuse buildings. So that's a big piece. And then, of course, creating efficiency in our buildings. So, that's one piece of it. And you're bringing up resiliency. And the point there is that we have to think about the climate, not just this year and next year, but in the next 50 years. And so we need to create the systems and the design, the orientation of the building that is going to allow that building to be able to be usable and valuable into the future.
I love that, this idea. Andy, come on, you got about 30 seconds left here.
Climate change is the moral and business imperative of our lifetimes. As Diane said, 40%, most people think that automobiles or industry are the largest. It's buildings that produce the most amount of CO2. We have put in place that by 2030, all of our buildings will be net zero. And that's really, really important. That's the focus for us. And I'll give you an example of one quick project. San Francisco Airport, the first net zero waste airport in the United States. So even publicly, like you were mentioning, Tim, it's coming, that municipalities are pushing for net zero.
It's a nice thing to hear, an upbeat thing to hear, because it does feel like sometimes it's a tough climb, especially when it comes to climate change. Andy Cohen, Diane Hoskins, co-CEOs at Gensler, their new book, check it out, Design for a Radically Changing World. It'll definitely get you thinking when it comes to your neighborhood and just developments in general.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
We're going to shift gears a little bit, talk about the real estate market, in particular here in New York. The vacancy rate for New York City's most expensive rentals plunging to 3.4% last year. Tim, that's the lowest in almost 3 decades.
All right, here's some more numbers for you. So we're talking about rental units costing more than $2,400 a month. Availability fell from about 13% back in 2021. That's according to the latest New York City Housing and Vacancy Survey. It reflects, Carol, a broader housing shortage in the Big Apple not seen going all the way back to the 1960s.
Yeah, so let's get to it. Let's get to the interview at this hour on the New York City real estate market, an important one and a closely watched one. With us is Lisa Lippman, licensed associate real estate broker at Brown Harris Stevens, joining us on Zoom in New York City. Lisa, good to have you here with Tim and me. What are you seeing in terms of availability when it comes to the housing supply here in New York City? What are you seeing in terms of demand for buyers who are looking for properties?
So we're seeing increased demand. Since about mid-December, I'm seeing a lot more people coming back to the market to purchase. We definitely had a lull from last spring, summer through the fall. It was quiet. And in the middle of December, sort of out of the blue, things started picking up. Hard to know exactly why. Often after a period of lull, we get busy again for obvious reasons. People need to move. People die, they get married. They have children, they get divorced. So things started picking up in mid-December. And I feel like this January and early February have been busier than the average early year. Usually our spring market starts more in March or April, but it started earlier this year.
Lisa, how closely is your business tied to the equity market and what we see in the bond market when it comes to rates in the 10-year and mortgage rates? That is, if we started to see markets move higher in November and December, is it fair to say that people would come off the sidelines and say, okay, wait a second, I feel wealthier now. I'm ready to make a big purchase. And at the same time, I'm also seeing mortgage rates come down slightly from what we saw over the past few months.
Absolutely. My market is definitely tied to those factors. Having said that, we have a lot of wealthy cash buyers in New York, which has continued to fuel our market. And the buyers that purchased in the fall were by and large cash buyers at every price point, from $1 million all the way up to $100 million. And even the uptick that started in mid-December that's continuing now, we still have a lot of cash buyers, although I'm starting to see people who will finance creeping back into the market.
Yeah, that's interesting. I guess, when we hear something like this, I'm always curious, Lisa, in terms of perspective. So like what you're seeing today in terms of the real estate cycle, how it compares to probably a lot of cycles you've seen. Is it a typical one, in terms of the amount of people buying by cash? Is it make sense, maybe the amount of people you're seeing, starting to maybe tap into some loans? I mean, give us some perspective, because you've been in the industry for a while, so you've seen a lot.
Yes. I've been in the industry for 25 years. And I worked through 9/11 and post 9/11 and the financial crisis, and then obviously, the latest big depression, recession. The difference now is that there are a lot more cash buyers than I've seen in the past. And, since I've started doing this, interest rates have come up and gone down. But this most recent rise in interest rate was the largest percentage rise. And that really pulled a lot of people back, freaked a lot of people out. I've been doing this long enough to know that, even now the interest rates aren't really historically that high. But in relation to what they had been, it freaked people out. But what we learned about the real estate market now is that there is so much wealth in New York that has been created in the last few years with the stock market that there's a lot of cash buy. There's a lot of cash out there, and there are a lot of cash buyers. Now, the important thing about cash buyers is they don't overpay. They expect to get a good deal because they're paying cash.
Okay, so if somebody's a seller out there and they get an all-cash offer that's not at their price point, what's the next step here in terms of countering in a realistic way, taking into account that this thing could close quickly and not necessarily be dragged on by the financing process?
Well, I always encourage sellers to look at reasonable offers carefully, and especially cash offers. If something's financing contingent, it's never as interesting. A cash offer is always interesting. And, something that we learned in the last 10 years when the market hasn't been as gangbusters as it might have been at different times. We had this really crazy market in 2005, 2006. We had a mini crazy market from 2014 to 16. But at other times when things weren't like that, any offer you get, especially cash, should be looked at seriously, and you should play ball with that person.
Hey, are all the buyers American?
Most of them are. I'm seeing about 80% domestic buyers, 20% are foreign money, but it's not where it used to come from. We see a lot more South American money. We see some European money. And then we see some money coming from Asia, but places like Singapore, Taiwan, Korea, different than we used to see.
So in other words, not seeing China.
Correct.
What about Russia? Are you seeing Russia?
We see no Russian money. I haven't seen any Russian money in several years.
It's funny, New York City, we always talk about location, right? When you talk about anything in terms of the real estate market, New York City has a lot of different markets in the residential space, uptown, downtown, east, west. So walk us through it. What are the properties that people are most interested in right now, or where in New York City?
All right, well, downtown's always popular. West Village is always popular. Tribeca, especially prime Tribeca, meaning west of Church Street, is always super popular. Soho, very popular. The 57th Street corridor, Midtown, tends to be less popular, except for the period of time where we saw lots of Chinese and Russian buyers buying there. Not to say that people don't buy there, but less popular. And then, of course, we have the Upper East Side and the Upper West Side. On the Park is always the most popular. And then beyond that, what's really been the most popular for several years is anything that's in really beautiful condition, move-in condition. People are very wary of doing renovation. It started before COVID, but certainly during COVID and since COVID, the cost of doing renovations in New York City is very, very high. And to get somebody to buy something that needs a lot of work, you really have to be priced very, very attractively. Otherwise, people just don't buy properties that need work.
What do you have on your radar, just in the last 30 seconds that we have, of perhaps the biggest shift that you can expect in the next few months as we get into that spring real estate season?
I think that it's going to get more competitive for buyers. Buyers have gotten used to, in the last 6 months, being able to sort of drag their feet, making offers, take a long time making a deal, expecting to be the only buyers. I think they will see more competition. So I think that'll be a change. But what I also want to warn sellers is sellers are always very slow to react to a softening market, and they're often too quick to react to a market that they see as getting better. So what will slow down our market again is if sellers start raising their prices. That there is a danger in that.
All right. Interesting take on that. Hey, Lisa, thank you so much. Lisa Littman, she is licensed associate real estate broker at Brown Harris Stevens, joining us on Zoom from New York City.
You're listening listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Okay, here's a bit of good news. Commercial property deals in the U.S. are starting to pick up. Here's the bad news. These deals are happening at deep discounts, and that's been forcing lenders around the world to brace for souring loans and mounting distress. This distress can be traced to issues stemming from COVID, like reduced office demand or apartments that were overbought in the pandemic frenzy at peak values, and is exacerbated by much higher borrowing costs. As of December, offices accounted for 41% of the value of distressed U.S. properties, which stood at nearly $86 billion. That's according to MSCI. For more, we turn to one of the most read stories on the Bloomberg this past week, which was also a Bloomberg Big Take. The brutal reality of plunging office values is here. The story by Bloomberg News real estate reporters Natalie Wong and Patrick Clark. It tells us how the plunging valuations of office buildings are being felt around the world. Pat joined us in our studio.
For a long time, we've known that office values in particular were way down, right? You can tell by just looking around how many people you see when you go to work. We knew that was going to have a hit that was going to play out across real estate owners and banks. We didn't know exactly how much because nobody was selling anything. And so it was very easy for everyone to kind of collectively put their head in the sand.
Because we didn't really kind of know how it was all going to settle, right?
Yeah.
A little bit.
Well, that's true. In 2021, there was still debate. Are people coming back to the office? When will it happen? There's going to be a recession. You're going to want to come and look good for your boss so you don't get laid off. You hear much less of that these days, and I don't know if it's because, we haven't had the recession or if, we've all sort of, the defenders of the office have sort of capitulated and come to accept the fact that attendance is not going to be what it once was. The buildings are not going to command the same rents when leases roll over, and thus they're not going to be worth as much money when they have to either be sold or refinanced.
Well, when it comes to people actually going back to work and using these office buildings on a daily basis, there are big regional and geographic differences here. The U.S. is a real laggard when it comes to where it stands in the world. How does that affect the way that buildings are valued in different parts of the world?
Yeah, well, it's fascinating, right? I mean, it's. I think the data that we have in the story is that Asia and Europe are kind of like 75-80% of pre-pandemic levels. In the U.S., we're kind of stuck at 50%. Is that because of the type of work we do here? Is it how people sort of organize their lives? I mean, I think you could argue that it has to do with housing markets, at least. From a U.S. perspective, I would say that, the lack of housing near, downtowns is something that makes remote working really appealing. Maybe someday we'll start converting all these office buildings into apartments, and that will improve inventory and affordability, and all of a sudden it will be easier to get people back to the offices. The offices just won't be there anymore.
Or maybe we won't, right? And this is kind of what we're facing with. I mean, what's interesting is it's good to see the market finally moving, but that valuation means, I think about global investors, right, who've had exposure in terms of the debt side of the equation and all the loans that went out. I mean, they're kind of caught holding this bag that now is not worth as much as it was a few years ago. So what's, we've talked about regionals, right? Certainly in the U.S. I mean, what are some of the implications? We're already starting to see some of this play out.
These were the safe assets, right?
That's right.
In the low interest rate era, this was like an alternative to buying treasuries, was buy an office building in New York or San Francisco. It's absolutely not great for the owners and not great for their lenders. And I think the thing that has started to happen is we're getting closer to certainty on where interest rates are going to settle. Greater certainty, right? People are now starting to feel like they know what their borrowing costs are going to be in the future. And so that's getting them to the point, and it's both owners and lenders. More certainty on interest rates gets you to the point where you can start to take some of the punishment that you need to on valuation now. Lenders are having to put aside greater reserves to deal with the fact that they're going to take back some keys on office buildings that they're then going to have to really. What are they going to do with that?
That was my next question. So let's say you are one of these lenders who gets one of these buildings at a deep discount, or perhaps you're a buyer who's looking to buy something at a deep discount. What are we starting to see now when it comes to this commercial office space that is actually what these buildings will be used for.
The place where I come out, I guess, is I don't see a ton of reason to think that things will go better for office than they did for shopping malls. I mean, it feels like it took us a really long time, and I don't think it's a solved problem. What do you do with office? What do you do with shopping malls when people no longer want to go to them, right? And there's obviously the malls that are great and people still love to go to.
Right, these experiential places.
Experiential, or just like high end or in the right place,
right.
You know, and
top tier properties.
We certainly have that in the office market as well. There are offices that will draw people in for a variety of reasons. Either the jobs are really good and sought after, or, you know, and usually it goes along with that, they make the office a pleasant place to be, like the office we're in right now. But, you know, many of these buildings are not going to be very successful in pulling people in. For a decade, we were writing, probably more, we were writing stories about the future of the mall and how do you repurpose a mall that is no longer a magnet for shoppers. And I don't know did anyone ever solve that problem? At some point, you just kind of either
kind of just dies out.
Or they become like Amazon distribution centers.
Right. At some point, but it's a lot of the times what did that is that the value of the building, the value of the mall, of the retail center, you know, became depressed, and a new buyer could step into it at such a low basis that it actually was functional as real estate. You could collect enough rents to make it work. It just didn't look at all like what it did before.
And this is where the economic outlook is really so important. You write, though, in your story, it's still too early. It's common for commercial mortgages to have 5-year or 10-year terms that amortize on a 30-year schedule, leaving balloon payments that need to be paid off or refinanced when a loan comes due. That's a fairly long runway, right? And I'm sure that if you're a lender, a commercial lender, you're going to do it. If you're a bank, you're going to do everything you can, right? Especially if it's a big loan. Like, you don't want it to default and come undone. So you kind of have some time to play with. So is this kind of a long, slow burn, or how do you see it in terms of the rest of commercial office in particular?
I hope so, right? Isn't that what we hope, that it's a manageable problem?
And we do. Not a crisis.
Not a crisis, a manageable problem. You space them out, right? You're going to extend certain ones. You know, sometimes something will be more critical and you'll have to take back, you'll take back that property now. But if it doesn't happen all at once and we do get relief on borrowing costs and it gets easier to refinance some of them, then, things could play out in a gradual and short of crisis way. And that's what we hope.
So the lenders are going to be okay?
Not all of them, right? I mean, nobody believes. I don't think there's any way that everyone makes it through intact, but some, I'm sure, will.
It's interesting, though. So much we're talking about is really U.S. focus, right? Because that's where we're seeing the biggest kind of valuation reset, Pat.
Yeah, and the global exposure is, through the debt. I mean, I don't think that's universally so. There are, multifamily owners in Europe who've run into trouble for sure. But we've got banks in Germany and Japan and all over the place who, again, they thought that financing an office building in Chicago was a safe way to deploy capital. Right.
We got this. It should be okay until it's not. Pat Clark, thank you as always. Really appreciate it. He's real estate reporter at Bloomberg News, joining us here in our studio. This story, as we said, it is the Bloomberg Big Take. It is among the most read on the Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Well, Treasury Secretary Janet Yellen said that while losses in commercial real estate are a worry, U.S. regulators are working to ensure that loan loss reserves and liquidity levels in the financial system are adequate to cope. Essentially worried about how much is on banks' balance sheets. That's what she was addressing.
Well, one big player in the commercial real estate industry is the Canadian asset management giant Brookfield. The company owns more than 700 properties around the globe, makes it one of the world's biggest owners of commercial property. $865 billion under management. Brookfield is second only to Blackstone among alternative asset managers.
Yeah, and Tim, as office values languish and higher rates persist, Brookfield finds itself at the center of a global real estate shakeout. In fact, it's still, though, raising a new real estate fund even after defaulting on more than $3 billion of U.S. commercial mortgages. That is top of mind when we bring in John Gittleson.
Yeah, he's part of the team that writes about Brookfield today. He's Bloomberg News real estate and investing reporter, as well as Los Angeles bureau chief. He joins us from our Los Angeles bureau right now. So, John, let me get this straight. Brookfield defaulted on more than $3 billion of U.S. commercial mortgages in recent years. And now it's going back to investors saying, we want to raise billions of dollars more from you to go and buy the same thing?
Well, they're saying it's not the same thing. They're saying now is a great time to invest because they will be able to buy office buildings, malls, and other kind of properties that they like at a discount compared to what they would have been a few years ago. And they also say, hey, everybody buys a whole bunch. Nobody bats 1,000. So these defaults are de minimis as far as our, total investments, and that put your money with us because we know what we're doing.
Are they right to say that? What do folks or investors in their funds say?
Well, I mean, that's what's interesting. That's why you play the game,
That's fair.
But their argument is they take a very value-oriented approach to investing. And they say the best time to buy is when other people are over-leveraged or mismanaged real estate, and we can get assets that have long-term value at a good price. Others in real estate take more of a growth approach to what they're investing, and they're saying there's too many office buildings, for example, out there. There's a lot of malls that are, zombie malls that aren't worth money. So they're putting money into industrial real estate, into data centers, into types of real estate that are undersupplied and have a growth story to them. And so it's really interesting kind of comparing it to stocks. Brookfield is like the value investor, whereas other companies are more the growth investor, thematic investments.
Hey, take us through the structure here of Brookfield and Brookfield Corp and Brookfield Asset Management. So what's going on with these two separate but related companies?
Feel free to bring in a whiteboard behind you.
Yeah, I feel like I need to. Family
That's
tree
okay.
type of thing.
We like props. Go ahead.
That would have been a good idea. I should have prepared a sort of org chart. But there's a parent company that is now called Brookfield Corporation. There was a spin-off that's called Brookfield Asset Management. And essentially, Brookfield Asset Management, which is 75% owned by Brookfield Corporation, manages outside investors' money and all of their separate funds. Brookfield currently has a real estate fund that they're raising, an opportunistic fund. Their target goal is $15 billion. This is like a closed-end private equity type fund. And they've raised about $7 billion so far. Brookfield also has an insurance or multiple insurance affiliates. They do infrastructure investing. They do energy investing. It's a very diversified company, but real estate is their biggest segment. And there are all kinds of interwoven parts and affiliates of this company.
We're laughing about the structure, but I mean, why is it important? I'm thinking about our audience who's listening or watching right now. Why is it important to is it convoluted? Is it not transparent as a result of it? Why is it important that we're pointing this out, John?
It's important to point it out for a couple of reasons. One is it is hard to say. It's important to say which part of Brookfield owns something. If it's part of one of these funds, which have a term typically of about 10 years, they're shorter term, they're more opportunistic. If the assets are owned by their by their insurance affiliate or by the parent corporation, they are more long-term investors. And sometimes what they have done is transferred properties from one of their shorter-term funds to their insurance affiliate or the parent corporation. And that way they can return money to investors in these funds, and they can hold on to a property over the longer term without necessarily having to sell at a time when the market is not paying the price that they think they could get if they hold on to longer. And a lot of these are income-producing properties that they figure, hey, we can keep collecting rent, making money on these properties, rather than being forced to sell to repay investors. So it works for them, but it also is a concern of investors who may think, are our interests aligned with theirs? Mm-hmm. Are they playing, accounting games by moving stuff from one segment of the company to another?
Hey, let's just end talking a little bit about Bruce Flatt. I was so surprised to read in your story that he became CEO of Brookfield Asset Management in 2002. And this is a guy who was in his 30s when he became CEO.
Correct. That was 21 years ago. He's 58 now. So do the math. Anyway, yeah, he was very young. I mean, he's been nicknamed the Warren Buffett of Canada, or Canada's Warren Buffett. He's a very, not a real colorful guy. His name is Flat. But he also has a long track record and, very shrewd, building this company from what was once a small, I wouldn't say small, but, he's definitely managed to grow it. And his value investing theme is a really strong, it's done very well by him.
Listen, and he's raising money for that new fund. And either the bet's going to be a smart one, and I guess time will tell ultimately about this. John, this is an incredible story. John Gittleson, another one from John, LA Bureau Chief, real estate investing reporter at Bloomberg News, joining us from our LA Bureau. Find it at Bloomberg.com or on the Bloomberg terminal.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Plenty ahead in our second hour of the weekend edition of Bloomberg Business Week, including a check on your New Year's resolutions. Have you been eating better, exercising more, getting more sleep? Or maybe your resolution is trying to learn a new language. We get an update from the CEO of the language learning app Babbel. Plus, from Athens to Mykonos, it feels like everyone has been taking a trip to Greece recently, except for me. More Americans are going to Greece. The Greece Minister of Tourism on why Greece can be a year-round destination. First up this hour, more real estate and a conversation with the CEO of a firm that works in multifamily, industrial, and commercial. Carol and I spoke with Michael Levy, CEO at Crow Holdings. It's a Dallas-based, privately owned real estate investment and development firm. They've got $31 billion in assets under management.
I'd boil down to three things. The first is the market is highly bifurcated in terms of haves and have-nots. And today, the have-nots is office buildings, and the have-nots is a lot of the downtown urban cores that are impacted by the flexible workforce and not having as many people there and the issues. There's a lot of haves in the business today, which is the industrial sector and the residential rental sector, the data center sector. So it's a highly bifurcated, not painting with a single brush across real estate in any way.
But you guys have some commercial office.
We have we do have, we're building a fabulous mass timber building, the largest mass timber office building. We have a fabulous office campus in Dallas. At the very upper end of the office sector, buildings like this, they're very attractive to people. They meet the modern needs. They're well leased. So the top third of office is great. The bottom third is going to be dirt. It just doesn't know it yet.
I just want to make sure I get this right. You're actually actively building.
We're active. We have a development company.
An office building.
Correct.
Right now.
It's the largest.
But in Dallas.
It's in Frisco, which is effectively Dallas-Fort Worth Metroplex.
Okay, so when did you start? When did you make the plans for that? Versus
after COVID. Right after.
So how are you designing that in this flexible work environment that you described?
First of all, the building is not made of steel. It's made of timber using a construction technology. So from a sustainability perspective, it's a much more sustainable building, which appeals to lots of corporations and individuals today. It's also physically beautiful because the interior is wood, so the structure is shown. And the layout is just big, open, collaborative spaces and amenities. And it'll be in a neighborhood with a hotel ultimately and other amenities, and people will be able to live, work, play in this area, and that's what people want.
All right, so you are a New Yorker. You understand this market really, really well, I'm assuming. You play in the commercial real estate space. Would you not want to be someone here in New York who owns maybe that second or third tier office property right now?
Like most things, it's all about what's your basis, your cost. But yes, as a general rule, let's just call it the bottom third of office buildings. A lot of these buildings you see, for example, on 3rd Avenue, for example, these are really tough properties that are likely to wind up in the hands of people who buy them at huge discounts to their value of just a few years ago and ultimately look to repurpose them. But this is a multi-decade problem. This is not going to be resolved in the next 2 or 3 years.
So no crisis?
There There's not a broader real estate crisis. There is distress in the office space,
right.
But if you really look at the percentage of exposure that people have to this asset class in the totality of the real estate sector, it's relatively small if you talk to the banks and their exposure. It's not going to take the financial system down. It's not going to take the real estate industry down. But those lower third of office buildings across the country, they're very difficult assets, and people are going to lose them.
Why do you think it's going to be such a multi-decade long turnaround, or at least experience?
Well, one, you can look at things that have already happened, like the mall sector, which started to get disintermediated in the early 2000s, and you can see lots of dormant malls all over America. The issue is, one, it needs to, from a price perspective, get down to ultimately the value of the land so someone can redevelop it and it makes sense. And secondly, the entitlement process, going from zoning and entitlements. Communities and neighborhoods don't necessarily want to entitle you for apartments, for example, if you were zoned for office. And so this takes decades, and it's going to take decades.
Michael, your company is 75 years old. Obviously, you haven't been there the whole time, but you guys have seen a lot of different cycles.
Years, right?
Yes.
I mean, if you had one word, two words to describe the real estate cycle right now, how would you? And I know that's hard because different geographies, different types, but how would you describe it?
Sure. I would describe it as we are just beginning to emerge because of the interest rate cycle and inflation. We are just beginning to emerge, literally just beginning to emerge from a very contracted, frozen period of time. 2024, it looks like, in terms of the capital markets and lending because of inflation and interest rates, the friction that's been in the business is beginning to be alleviated. So there's a capital market cycle that's been destructive with respect to valuation levels and transaction levels. But the fundamentals, rental growth, occupancy, with the exception of the office sector, have been great generally across the country in most major markets.
You are obviously watching the rate cycle very carefully. Does it matter if the Fed does 2 rate cuts, 3 rate cuts, 5 rate cuts this year in terms of what it means for your business?
I don't think there's a very direct correlation. I certainly would not speculate that 2 is bad and 5 is good. I can just say in general for our levered asset class, don't fight the Fed. And if the Fed is relaxing rates and they're coming down, that's going to be good for our industry in terms of transaction activity, financing, valuation levels, the grease that allows the industry to move forward.
We recently spoke about a Bloomberg Big Take by our own Sean Donnan about how Americans are moving around, especially in swing states, and that could impact the presidential election outcome. You have people all over the country. You have businesses and properties all over the country. Give us some color about the demographic trends that you're seeing.
Yeah. Look, there is no doubt America is moving to the Southeast and Southwest. Now, at one level, that's a 75-year trend when air conditioning started, but it has accelerated. It's sustaining itself. And it's a virtuous cycle. Cities that 30 years ago, as someone from New York you may not wanted to have lived in, today are vibrant and with restaurants and culture and food. And so this trend is continuing.
Does that make you bearish on New York?
I think...
Be careful. There's a lot of New Yorkers now.
I understand. New York has some very significant challenges, not as difficult as some other cities such as San Francisco. But the reality is, our office buildings, this was a city that forever has been first work, second play, third live. Well, people are coming into the office a lot less. And if they come into the office a lot less, that means not only the office is occupied less, the retailers have less. It's hurting. Yeah. On top of, people are, not only people, but wealth and business is leaving the city and the state. You can look at the data for lower cost, higher quality of life markets.
We got to run. Really a great perspective. Michael Levy, Chief Executive Officer of Crow Holdings, joining us here at our New York studio. This is Bloomberg Businessweek. Michael, thank you.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Well, a gauge of pending U.S. existing home sales rebounded sharply in December to a 5-month high, suggesting the recent drop in mortgage rates is helping to stabilize the resale market. That recent drop, by the way, in mortgage rates also helping to bring sales of new homes in the U.S. past forecasts in December. We got that data yesterday. And in general, we've been thinking a lot about real estate and talking to different voices in different sectors of the industry.
Yeah, some sectors that we've covered in recent days have been office, hospitality, hotel, industrial, but it got us thinking more about so-called alternative real estate assets. We're talking about senior housing, self-storage, student housing, and more. It's top of mind at Harrison Street, a company that focuses exclusively on so-called alternative real assets. The company has $55 billion in assets under management with more than 500 institutional investors around the world.
Christopher Merrill is CEO of the Chicago-based Harrison Street. He's in town and he joins us here in our Bloomberg Interactive Broker studio. So great to have you here. We like to start big, broad. It's a new year. How are you looking at 2024 and how it compares to coming off of the pandemic and then even pre-pandemic?
Sure. Well, thank you for having me. It's great to be here.
Yeah.
You know, we look at this year and we're absolutely excited about the alternative segments. To us, this is now sort of the second black swan event we've been through as a firm. We were the first mover in alternative real estate starting the business in 2005. So we saw how these alternative assets did in the global financial crisis, and then we saw how they performed in the pandemic. So coming out of this environment and going to 2024, what you have is a situation where demographics are solid, they're strong, but supply has been choked off. So many asset classes that you mentioned have a ton of headwinds. When you think about what's happening in student housing, senior housing, medical, life science, tremendous tailwinds right now as demand's increasing, enrollments are up at schools, aging population, and there's no supply. So we look at this as some of the greatest vintage years we're going to see for some time.
I understand that for life sciences, medical, senior housing, student housing, but self-storage, isn't there a glut?
You know, it's interesting. Self-storage is a fantastic asset class, and it really is one that you have to look market by market. It's a sort of not in my backyard asset. But the great thing about storage is people use it in good and bad times. It's life events. It's
and also
marriage,
people never get rid of their stuff.
They don't ever get rid of them. In fact, I have a few of them.
Never seen storage war.
It's so uniquely American.
But it's amazing.
But isn't there a glut of it? I mean, doesn't it drive prices down?
The way we do, how we invest in alternatives, because there's a lot of different ways to invest in alternatives. We like to invest in asset by asset, create portfolios, and then sell to the larger players. So for us, there's a huge demand in owning these assets. It's consistent cash flow, month-to-month leases, so in an inflationary environment, you can really reprice. And so what we like to do is do the hard work, build portfolios, and then sell to those groups that are really trying to get exposure to the asset class.
Isn't it nice that self-storage also has 0 employees, so their overhead is so low?
It's amazing. It's the lowest default asset class. You get about the same rent per square foot as an apartment, but you really don't have a tenant. When someone leaves, you roll it up, you sweep it. So it's a great business, but the challenge with it is it's an easy asset class to build. So you have to go into markets where it's hard entitlements because it's not in my backyard. So you got to find high barrier to entry markets. Once you own those assets, fantastic.
What happened during the pandemic to all of those assets?
So what happened, it was fantastic, during the pandemic because at first people were nervous. What's going to happen to student housing? What is online learning? What's going to happen to your off-campus housing environment?
And self-storage particularly.
Yeah. I mean, what happened with all these asset classes is just consistent. People that were doing businesses online were using storage facilities. People were, when you thought about people moving, there was more flexibility. So people were starting to move into other markets, right? You saw a lot of remote working. So people were traveling, moving. And so they were using storage.
And student housing, same thing?
Student housing was fantastic because really the students didn't want to be in mom or dad's basement. They wanted to stay in their off-campus apartments.
I saw it with nieces. My daughter wasn't in college yet, but my nieces didn't care if she was on college. I think it was her first year. She was a freshman. Yep. And I think after having to stay home for a little bit was very happy to be at least on campus. Had a whole dorm room to herself.
And that's what's happening. You look at the Power 5 universities, enrollments are up. You're seeing rent increases 8 to 10% a year. There's just no supply.
Talk to me about the type of student housing you do, because not all student housing is created equal. I know that the student housing that I experience, student housing that I experience isn't necessarily the same student housing that other folks have experienced. So.
It really is a different level of quality than a lot of us experience. But it's really
is that what you say?
Well, I mean, it's what it is.
Does it come with a beer-soaked couch outside?
Maybe
beer-soaked couch outside.
I think that the key with the business is it's all bed bath parity. So it's like multifamily, but really what it is not bed bath parity. 3-bedroom, 3-bath. But it's a real focus on gated, well lit, safe. Safety's a big issue. So that's really a focus is creating an environment where you are providing safe environment, study rooms, amenities, health clubs, et cetera. So,
but are these student housing? Are these student houses that are multi-unit that are affiliated with a college or university? Or are you essentially building like a huge building of apartments?
So a big part of our business, we're sort of the largest owner of off-campus housing. So that's not really affiliated with the university. It's off-campus. But the school loves it because it becomes an amenity of the school. They can say to a student, when you're a sophomore, junior, senior, this is where you can live. So the schools like working with good managers. We also have a part of our business, what we call our P3 business, where we're doing public to private partnerships with universities, where we're working with and helping them build dormitory, because a lot of these big universities don't have the capital.
Yeah.
So we've probably got 30 to 35 universities that we are actually helping them with their housing.
Hey, security deposits in student housing. Yes. What's the average rate that you actually keep from those? Because these people just destroy the rooms, right?
You know what? It's fascinating that if you provide a nice, high quality product and you walk the units on a regular basis and you have the willingness to kick children out if they're not taking care of it, and you're billing the parents, actually they're taking very good care of the units. And we have a higher percentage of women a lot of times in these units. And so you're actually seeing it's not the type of thing. And that's when we started the business. It was student housing is an institutional asset class. It's Animal House. There's no way this is going to be institutional. But I think people have seen how the industry has really developed. And it's really become an asset class where insurance costs are lower than multifamily.
Right.
You have better rent growth than multifamily. And you have really sticky, strong demand drivers.
Well, and you have parents who are footing the bill.
And you have parents who are footing the bill. So from a credit standpoint, you think of owning a multifamily versus owning student housing, we have great credit.
Sticky, not because you spilled Jell-O shots everywhere.
I have to tell you, I go and
I hang out with you, Tim.
There's a story there. I've helped my daughter move out, and I am amazed at some of her roommates are like, yeah, we'll just leave that in the fridge. And I'm like, nope, you're cleaning it all out.
Yeah.
Everything's going to be clean because I want the security deposit back.
That's right.
I'm a tough cookie.
You're bringing me back, Carol.
Senior
housing?
So senior housing.
So senior, yeah.
We're just getting older?
People are getting older, but the challenge is, and there's different ways to invest in senior housing. We're
all getting older, but we also
we're having memory
right.
issues, assisted, dementia. So where we focus is on independent living, memory care, dementia, rental, and private pay.
Right.
We don't focus on skilled nursing. That's more public pay issues. But when you look at what's happening, 5 million people turning 80 by 2030. There is not near enough supply right now. So we're going to wake up in 4 and 5 years and wonder, where are we going to house all of the folks that have memory and health issues? It's almost impossible to take care of a loved one that has Alzheimer's dementia. So it is a very important asset class. It's hard. It's not easy. You need great operating partners. But it's a business that we're very bullish on, and we're seeing occupancies back to pre-pandemic levels right now.
How do you design for that, just in the last 30 seconds that we have?
I think what you do is we have folks that have been taking care of dementia and Alzheimer's payers for decades. So it's really about what paint colors you use. How do you do carpets? How do you do the right caregivers? And so really for us, it's about choosing great local partners to work with.
I've seen it firsthand, and there's safety issues, so somebody can't just walk out. There's a lot of safety measures in place. Favorite market right now? Geography, real quick.
I think right now we're active in the U.S., Canada, and Europe, and so we love all those markets. So for us, if I'm near a great university or near a great hospital system, that's where we want to be. And so we can be really diversified across the U.S. and Europe. And so it's hard to pick a favorite market. We just love some of the fundamentals right now.
All right, can leave it there. Real fun. Thank you so much. Have a great trip back home to Chicago.
Thank you.
Christopher Merrill, he's the Chief Executive Officer at Harrison Street, joining us here in our Bloomberg Interactive Broker studio.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So we wondered too about the hospitality side of the business. The Bloomberg REIT Hotels Index has rallied 26% since late October. And we got the perfect guest with us. Kevin Davis is CEO of America's Hotel and Hospitality at JLL, Jones Lang LaSalle. It's the publicly held real estate and investment management consultancy. It trades under the ticker JLL. Kevin's here in our studio at Bloomberg headquarters in New York. Good to have you with us this afternoon. Welcome back.
Great to be here.
Our Bloomberg Pursuits team called it already. They said 2024 is going to be a record-setting year when it comes to travel on the tourism side, on the business travel side. First up, though, at JLL, you're involved in office, industrial, retail. Give us size and scope here when it comes to the hotel and hospitality business that you're in charge of.
Yeah, so our business relative to some of the other asset classes is relatively small, but certainly our impact on GDP is relatively large given the number of people that work in hotels and hospitality and leisure around the country. So I'd say it's a business that has a pretty significant impact on the economy.
Yeah, absolutely. And you guys obviously want to get into it because why? And you assume you can grow it to how much of your business?
Look, we have aggressive and ambitious growth goals. And so our hope is that we continue to move the business forward and make significant strides in terms of growth.
I mean, is it going to grow faster? Is it going to grow faster than office, industrial, and retail?
You know, it's hard to say. Certainly some of those sectors have been challenged and are in the midst of recovering. I will tell you one of the things that we're super optimistic about as it relates to hospitality. It has proven to be a strong inflation hedge, and while inflation looks like it's in the rearview mirror, as a result of that, it's attracted a lot of institutional investors into the space. And also hospitality typically offers incremental yield relative to other asset classes, and so as a result of that, investors are coming into the space.
Kevin, you talk about investor interest. Quantify that. Give us an idea of how it was maybe pre-pandemic. I mean, tell us because how long have you guys been building up this business?
I mean, we've been in the hospitality business at JLL for over 25 years.
Okay.
So this is a core business for us, and we are leaders in the space. So just by order of magnitude, and I'll give you global numbers. I mean, generally, globally, hospitality, it's typically between $75 and $100 billion worth of transactions that take place in a given year. Last year, globally, we had about $50 billion worth of transactions. So we were down about 30% relative to 2022. But we expect that it will likely increase, sales volume, transaction volume will likely increase 15 to 25% this year. So we are on the way back. We don't expect to get all the way back this year, but we think we're on a great trajectory toward stronger transactions activity.
What's fueling that? You talk about investor demand. Is it because we're expecting a lower rate environment? Is it because you expect the economy? And I'm curious, when you look at the economies, I'm assuming it's the U.S. and elsewhere, or is it the U.S. specifically?
Yeah, it's strong growth in the U.S., strong growth in Europe. Globally, though, relatively speaking, we actually expect more growth in Asia, which has been slow to emerge out of the pandemic.
Japan?
Japan has actually started,
Okay.
but more specifically China, which has recently opened up much more. So we expect that you'll see strong growth in China. Also, inbound travel from China to the U.S., which is something that certainly it's not close to recovering to what it was pre-pandemic.
Hey, talk a little more about that, because we've talked a lot on our program about the struggles that China faces internally, the struggles that they face with their own property market, with the economy, with youth unemployment, with demographic challenges. Why are you bullish on China?
Well, I'm bullish relative to what we've seen over the past couple years. I'm bullish in terms of Chinese travelers getting out and traveling. I mean, you ultimately have an emerging and growing middle class in China. And as the middle class grows, we expect that more people will travel, and will travel specifically to the U.S. And to Europe as well.
So what type of hospitality properties do you think investors are investors kind of clamoring for or asking for of you guys?
Absolutely. It's really the two poles, if you will. It's luxury, which has performed exceptionally well coming out of the pandemic, and it's select service and extended stay assets, which have also performed well.
What's select service?
Select service, so typically you don't have extensive food and beverage. It's primarily rooms.
Okay.
And you typically don't have a lot of meeting space. So you wouldn't, if you're going to a big conference, you're generally not, the meetings are not going to be at a select service hotel. You'll typically go to a full service hotel that has meeting space and banquets and catering, et cetera. Part of the reason why the select service space has grown, though, particularly extended stay, is people have a lot more flexibility now post-COVID as it relates to work. And you've seen a bit of the blended business and leisure travel, the so-called bleisure travel. And so because people have a lot more flexibility to travel when they are frequently on the road, they want a bit more home-like amenities. So extended stay, which typically have kitchens, are attractive. And that's a sector where we expect to see a lot of growth.
What about regional differences here in the U.S.? You talked about where you're seeing action globally, but what about here in the U.S.?
Yeah, so in the U.S., it's interesting, and it's changing. In the first couple of years out of COVID, we saw strong growth in the Sun Belt and the resort markets, which we expect to continue. We saw a meaningful contraction in the urban markets, New York, Boston, Chicago, Los Angeles, San Francisco. But the trend that we started to notice last year, which picked up steam and we expect will continue over the course of this year, is really improving performance in urban markets. So again, the New Yorks, the Bostons, Chicago, et cetera. The reason, there's really threefold. You've had return of leisure travelers. For many years, people were concerned to go to an urban city, to an urban market because of the pandemic. So you've had leisure come back. You've also had group travel come back. So people coming to the cities for meetings. And then you've also had a sector called business transient, which are business people coming to meet with clients and colleagues, et cetera. So that segment is all coming back. The other part, the last component though, is the global, which is early days of coming back, but we expect that that will pick up in earnest, and that's going to drive performance in markets like New York, Boston, San Francisco.
So go move a little bit more on San Francisco, because I feel like, Tim, we've had some different guests who are, it's fine, it's coming back. Others
say, no way, we're not touching it.
And that they make it so hard to build or do anything in that city. So you see opportunities there.
Look, San Francisco is a gateway market. It's a top 5 market. It's not going anywhere. Certainly it's having its challenges now. There are political issues, social issues, et cetera. But we certainly believe that longer term, San Francisco is going to be a great place to invest. And so, yes, the market is challenged today, but we think this is a short, medium-term issue, which over time, San Francisco will recover.
You sound really optimistic.
I am
Bottom line. So what's the risk out there? I mean, we have spent so much of January, laying out quite a long list of risks for folks out there, whether it's geopolitical, politics here in the U.S., and elsewhere. What if the Fed gets it wrong? Just got about 30 seconds. What's your number one risk that could kind of upend this optimism?
Number one risk is if the Fed doesn't cut rates as aggressively as the market expects.
So 6, 5 you want?
Or look, I think it's at least 3.
Okay.
Or if the rate cuts get pushed to later in the year. I think if one or both of those things happen, that will take some, not all, some of the optimism out of the market, and we may be on a slightly different trajectory, but ultimately we feel very good about 2024. All
right, well, this was a fun checkup. Thank you so much. Have a great weekend.
I appreciate it.
Kevin Davis, he's Chief Executive Officer of America's Hotels and Hospitality over at Jones Lang LaSalle, joining us here in our studio at Bloomberg headquarters.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Never too late to be talking about a New Year's resolution.
Yeah, maybe things like eating better, getting more sleep,
as
working out more.
We just munched on our popcorn.
Yeah, hey, popcorn's okay. Maybe a New Year's resolution for you, Carol, is learning another language.
Yeah, I could kind of brush up on my Spanish.
You have so much spare time.
Yeah, exactly. I can multitask. Well, there are plenty of online platforms out there to help you do that. Among them, though, is Babbel, the Berlin-based company that does exactly that, helps you learn a new language.
Well, we've got back with us Julie Hansen, the U.S. CEO of Babbel. It's a role that she's had since 2017. We should note, Julie also the former COO and president of Business Insider. It's a role that she served in when Axel Springer bought BI back in 2015, valued the company for $450 million. Julie joins us on Zoom from New York. Julie, good to have you with us this afternoon. How are you?
Good. Thanks for having me, Tim and Carol.
Yeah, well, thanks so much for coming back here. So I kind of made this joke about having so much spare time there, but at the same time, the whole point of the app-based companies that help you learn another language is that you kind of do them when you do have a few minutes. Talk to us a little bit about how you differentiate Babbel in a marketplace that has Rosetta Stone, it has Duolingo. There's so many options out there for people to learn another language.
You're right, there are. And it is a great New Year's resolution. So I love that Carol is on it. And
trying.
One thing. We do say that with Babbel, you only need like 10 to 15 minutes a day. And that's actually really important because you'll do better learning consistently versus binge learning. I think it's probably like studying for a test in college. You want to keep going with a daily habit versus one giant study session. But Babbel is very much about learning efficacy. We are about getting you conversational. It's not comparable to college in that sense. We understand that our users want to learn a language to speak it and use it in their lives, not to pass a test necessarily. So that's the focus. We use a lot of human intelligence augmented by some artificial intelligence, but the role of teachers in creating our product has been super important over the years. And we now have teachers actually giving live lessons in our Babbel Live product. So I think that's a quick way to think about Babbel.
What about from the perspective of a business that needs its employees to brush up on a new language or learn a new language? Because there's a business side of this too, in terms of where the revenue comes from, at least here in the U.S., your U.S. CEO, of course. What is personal use of it versus business and enterprise use?
Absolutely, the fastest growing portion of our business is the B2B business, the business use. And that's very interesting in the U.S. It's quite different from the use case we see in Europe. So in the U.S., we really have one main use case, or two languages that together make up a main use case. So English speakers learning Spanish, Spanish speakers learning English. We have many different industries that we serve, but we're clearly seeing a trend toward those industries that have a large proportion of Spanish-speaking workers in them. So that can be anything from healthcare, even to like manufacturing, construction. And it's interesting. And baseball, by the way, we have something like 8 MLB teams working with us, and it's bilateral. We find workers learning English, managers learning Spanish. To generalize, there can be a mix of those two, of course, but that's the general trends. And that definitely ties in with the trends we see in the U.S. in consumer, where Spanish is by far our biggest language.
Are you seeing this added at all as a workplace perk? Like companies that are saying, come work for us because we believe in continuing education, and we'll pay for you. Like, for example, here at Bloomberg, now we have virtual physical therapy. That's new this year. I think I can talk about that. I hope I don't get in trouble for talking about it. I think it's a pretty cool. I think it's a pretty cool new thing. But would an HR department ever say, we want to attract and retain talent? One way we can do that is by offering Babbel. Do any companies do that?
Yeah, absolutely. Maybe a little more so in Europe than here, but it's a good use case in both cases. For example, we work with a major ad agency that has a large international program where they move their people around, and they bought a large license to prep people for those trips. So, that's kind of it's a perk for them. So yes, that is a use case. But honestly, I'm a little more excited about the use case where I feel we can really make a difference, which is around safety. In a lot of our B2B situations, we have workers in, say, meatpacking or manufacturing or warehouses, and there are safety issues if they can't communicate with their teammates or their managers. So, making the chance for Babbel to improve the safety of people's jobs, but also their career prospects, their earning potential, that's really exciting.
Hey, do you ever worry? It's so funny. We had a conversation with our Rachel Metz, who covers all things AI and all the stuff that's going on. Are you worried, though, at all about chatbots kind of replacing some of what you do? And I'm like, even amazed on my phone, I can type something and it translates it right away and it just sends it off to whomever. So I do think about that is potentially a threat to what you do. So I'm curious, does it keep you up at night, or how are you thinking about that and how it applies to kind of what you do, or maybe how you guys adapt to that?
There's kind of fringy use cases where that can erode the need to learn a language if you're just using it for those sort of transactional interactions. Our learners, generally speaking, want to communicate. They want to learn a language to speak to someone, to take that trip, because their mother-in-law speaks a different language, whatever it is. And, people already, 5 years ago, people went traveling and held up the phone, to use as a live translator. So that use case, I think, is already well established, and we don't worry that much about that. Our purpose as a corporation is creating mutual understanding through language. So, mutual understanding is really much deeper than quick translation.
Well, speaking of AI, Carol brought it up. Are you using and integrating AI tools at all in the way that you develop courses, the way that teachers develop courses, and then deploy that for people to learn?
We are, and which is very exciting. We've actually had a machine learning and AI in the product for a long time now. One of the key concepts that you find in our product and in language learning in general is this notion of spaced repetition, where we bring things back to you and remind you of what you've already learned. And so there's quite a bit of machine learning in the product that does that, just to use one example. And we see we're in the works direct features where a consumer can interact directly with the AI and have a conversation and get training that way. So, we think that AI is fantastic, augmented by HI, the human intelligence. Those two go together really nicely.
So how do you think that will change the way the business is run in terms of margins or in terms of, how you guys are able to run the business? Does it have does it have an effect on the bottom line?
I hope so, because otherwise, it's expensive to use AI. So if we only add costs and don't figure out how to be more efficient with it, we will have a problem. We actually have initiatives kind of across the whole organization to use AI and to come up with use cases and experiments, et cetera. So everything from marketing, copywriting to, deep feature development in the product. We're embracing AI. But we don't really have any. I think we expect there to be cost savings that come out of this, but we're starting really more with the efficiency, productivity, and user experience as the primary goals.
All right, Julie, where we started. So I am curious, New Year resolutions. Do you find a jump in people on your platform at the beginning of the year because they're like, yeah, I think I want to lose some weight and I want to learn a new language? Just give us an idea. We have about 30, 40 seconds left.
100%. January is the biggest month of the year. Every year, it's super important, and people tend to subscribe in January, and then they really use it. So our job is to keep them going throughout the year, but absolutely. And if you think about it, January sets you up for your spring and summer travel. So it's very important.
All right. So what's the weakest month? I'm curious now that we went down this path.
The dead of summer, especially in Europe, where everyone's traveling. Like, they're getting the payoff for all that work they've done to learn the language in the summertime.
I want to drink the margarita rather than learn the language of
like I said, they go hand in hand. You got to be on the ground in that country to actually learn the language as well. That's a big part of the education.
I totally agree. You immerse yourself in it.
Yeah.
But this is a good starting place. Julie, thank you so much. Julie Hansen, U.S. CEO of Babbel, joining us on Zoom in New York. Great to check back with her.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
All right, so I don't know about you, but at certain points over the last couple of years, I know, Tim, I've thought about going to Greece. I was just talking to my daughter who's planning, she's overseas. That's on her list before she heads back home here to New York. And you open up your Instagram a lot and think about it.
Yeah, try not to open up my Instagram too much because, hashtag FOMO. But it does feel like at certain points of the year, everyone in my feed is either in Greece or Italy. I don't know what's going on.
Yeah.
It's actually not our imagination here, Carol. More Americans are going to Greece. In November of 2023, tourist spending by U.S. travelers increased by 62.4% to more than 65 million euros.
All right, so there's a lot of folks. And Greece wants even more Americans to come and spend time and money in Greece. And that's why Olga Kefalogianni, the country's Minister of Tourism, is here in the United States. She joins us now here in our Bloomberg Interactive Brokers studio. Olga, a pleasure to have you here. First up, why are you in New York?
Well, thank you very much for hosting me, and thank you very much for giving me the opportunity to talk about what we're trying to do in terms of tourism in Greece. Of course, the American market is a very important source market for Greek tourism, and 2023 was a record year for Greek tourism as a whole, but both in terms of arrivals, also in terms of revenue, and it was also a record year in terms of Americans arriving in Greece and spending in Greece.
Show us the pie, like how much in terms of tourists, how much are from America, how much are from elsewhere, maybe from the European continent or so?
Well, the majority of our visitors are from European countries, so we believe that there's a lot of room, for the increase from the American market. But up to a couple of years ago, we didn't even have a direct connection. So this was actually an impediment. So nowadays we have direct connections through New York, Boston, and Chicago. And this year, 2024, we'll be having even more connections. So I think direct flights are important.
So there were no direct flights?
There were direct flights, but they were not year-round.
Okay.
So they were very seasonal.
So what do you think when an American is making the choice about where to go on vacation and they're choosing, they're in that stage where they're planning that trip, what prevents them from choosing Greece? What's the barrier that they need to get over?
Well, first of all, I think that connectivity is very important. So we are very happy that nowadays there is more of a direct connection through a lot of airlines. But I think that an impediment, if this is the correct, let's say, word, would be that Greece is mostly associated with summer vacations. So Greece is always associated with the Greek islands, a beach vacation, sea and sun. And there is a lot more in Greece than just that. So what we are trying to do is extend the season and promote Greece as a year-round destination for Americans throughout the states, because it's not just the East Coast, it's also the West Coast and all the other parts of America.
Well, remind us about the weather in Greece, because it is true. Like when I'm thinking about when traveling, or I know my daughter, she was looking when we went and did some overseas traveling in December and talked about Greece, and I'm like, I think it's kind of cold there in December, but give us an idea. So as you make it year round, I mean, the weather is, supportive of doing what in December, or like give us an idea of how you're thinking about that year-round approach.
Well, when we're talking about the year-round approach, that means that of course you can't have year-round beach vacation, but the weather is very moderate year-round, so you would have a very nice experience in the countryside, the mainland Greece, mountainous areas, and you can have some activities outdoors in the nature, like trekking, rafting. For anyone who's interested in gastronomy, of course, Greece is associated with really good food.
Check.
So I think that you would find like a Michelin star restaurants in Athens,
Greek
but
food is
also super cute and super nice tavernas in all parts of Greece.
We had an executive from a real estate firm based in Texas on a few weeks ago, and he's a New Yorker but moved to Texas to become the CEO of this job. Then he's CEO of this company, and he told us, we're asking him what he missed about New York, and he was like, I can't get any good Greek food in Texas, like in the entire state. He's like, when I come to New York, the first thing I do is I go get some Greek food. Not, of course, saying it's anything close to what you'd find in Greece, but
yeah, but even for us, when we are in a Greek island and we have the fish that is just like caught fresh fish, and it's just grilled fish. You don't really need to have a lot of seasoning or very cooking in a very particular way. You just have like very, very good raw materials, and then you just have like olive oil, Greek olive oil, and it's like the best meal that you can have.
I'm sold. I want to talk a little bit about balance, though. Tourism is certainly important, but also maintaining historical significance, maintaining artifacts, and making sure that the place isn't overrun with tourists. How do you find that balance?
Well, it's actually the biggest challenge right now, and this is why I'm, as a minister, I'm always talking about, like the new era for Greek tourism, which takes local communities' needs into account and to significance when it comes, to planning, because we see that, of course, tourism is a very big source of revenue for the local economy. It's also a very big generator of jobs. For Greece, tourism represents almost 20% of GDP, both in terms of direct and indirect contribution. So you see this is a very important economic activity. But at the same time, we see that there's a lot of pressure to the local communities. And of course, we really need to protect and preserve our natural environment, our cultural environment.
When your blue economy, I have to say, I am obsessed. I'm a sailor, and my husband and I are obsessed with some of the YouTubers that sail the world, and they spend a lot of time in the Mediterranean. And certainly in your neighborhood and at your home, and that economy in terms of supporting fishermen, the ocean economy, the blue economy is so important. So just to kind of push a little bit more on what Tim was asking about, like that economy, you want to make sure that doesn't come undone by a mass move of tourists into the area that maybe it can occur. Because I see it in areas around the world as a diver, like just whether it's cruising or cruise ships or just overdevelopment that just really messes up the ocean economy. And then impacts a country or an area.
I couldn't agree with you more. This is why our strategy is focused on sustainability, and we take sustainability when it comes to the marine environment very, very seriously. This is why we just founded this observatory for maritime and coastal tourism in the Mediterranean region.
Mm-hmm.
So we did this in collaboration with the UN World Tourism Organization. So Greece, let's say, will be in the forefront of preserving the coastal and the maritime environment in the Mediterranean, because of course it's very important for all insular nations and coastal nations to preserve the marine environment. So in this respect, of course, we are reviewing our strategy when it comes, let's say, to cruise ships.
Oh, interesting.
I know that...
Might you guys push back a little bit?
I know that it's of big interest into the American market. But, at the same time, we cannot be having so many cruise ships, so many large cruise ships in Greece. So we are thinking of, applying some quota and having a more strict berth allocation system. So I think we should find, as you said before, the correct balance. Mm-hmm. So we need the revenue, but at the same time, we need to preserve what makes us really unique and authentic and attractive, as a destination.
30 seconds, and then we're going to do some news and we're going to come back. But what is specifically about the cruise operators do you find that you need to push back on?
Well, you see that especially in some of the very, very popular islands, such as Mykonos and Santorini, it becomes very frustrating even for visitors who are on the island and also for the islanders. So we really need to find the right balance. And of course, I understand, that there are people who really enjoy cruising, but then again, you need to have everything in proportion, let's say. Like Greece is a smaller country, so we need to have, proportionate and balanced approach to things.
So, Olga, we're looking at all the different places we could go in Greece. We're already excited to plan our trip. Want to talk about costs. You're here in New York. You were telling us while we were doing news that it's shockingly expensive to be here in New York.
I'm sorry, I can say that.
Yeah, of course.
Air.
Say whatever you want, please. Yeah.
Like, really,
this won't be news to anyone.
Is it everything?
I used to live here 20 years ago, so it's not like I haven't been used to, like, New York being quite expensive compared to other places. But I think that nowadays it's like super, super expensive.
Everything? Are you talking about hotels, food, everything?
Especially food. I mean, compared to the prices that you would have in Athens. So for the prices that you would pay here for a relatively mediocre restaurant,
plenty of those.
You would have the same, let's say, price in a Michelin star restaurant in Athens. So you understand that the quality that you pay is not comparable.
What about lodging when it comes to paying for a hotel? What's the range?
Well, the good thing is that there's a very big offering. So I think that depending on your budget, you can find, something that's equivalent, to what you want to spend.
How do you, as Minister of Tourism, think about a company like Airbnb? Because it's pretty controversial. There are some folks in governments who don't like it because they think that it displaces housing for people who live in areas and drives up the price of housing. How are you thinking about it?
Well, it's true that it's a challenge nowadays. Finding again the word is the right balance, because of course we understand that there are a lot of people who would only look into this kind of accommodation, that they wouldn't go to a hotel, so they would look for short-term rentals for their vacation. So as a country that appeals to a lot of people, you of course need to have all sorts of so the whole range of the offering when it comes to accommodation. So both hotels and also the short-term rentals. Well, at the same time, if you do not have a framework, then of course this creates a lot of I would say social issues, especially when it comes to prices for locals, so for accommodation for locals. I'm also a member of parliament, so I represent Athens, and we see that, in the recent years, some very nice neighborhoods that used to be like full of younger people are now younger Greek people are now no longer residential areas because they're very near the Acropolis. So it was, it made much more sense for people to just rent their apartments for visitors through these platforms, Airbnb and other platforms for short-term rentals. So nowadays we have a stricter framework. And really, we try to have a very balanced approach because, again, we understand that this is something that appeals to a lot of visitors, but at the same time, we also need to have both the revenue, the correct revenue, and also, we don't need to have like the unfair competition to hotels, which have to go under a lot of scrutiny when it comes, to the Ministry of Tourism's controls and legal frameworks for the way that they operate.
Okay, I want to go back to what your mission is to really expand tourism. Summer, check, you got it down. There's lots of people who come in, but you'd like to expand it throughout the year. And what's interesting is your Prime Minister was on with our TV colleagues in the fall, and specifically he made the point that, part of the reason that you guys can expand potentially your tourist season is because of climate change, right? That it's impacting a little bit the environment. So that's kind of an unforeseen, I don't want to say benefit, but right? Because of what's happening, you're just seeing warming right throughout the year.
Well, the climate crisis, I think, is an issue for everyone to address, in a very, very strict manner. So I understand that there's a silver lining for everything, but I think that the most important thing is, to really address the impact of the climate crisis and really for every country to do whatever they can to reverse the effects that we see in the environment.
Right.
And I think that this is important for us, and it's important for our children and the future generations. So I think that all of us have a very big responsibility when it comes to the environment and the climate. Greece has a very strict, legislative process right now when it comes to the environment and environmental protection. And we have a plan for having all our hotels sustainable by 2030.
Right.
So this is the most important thing for us, that we see the climate crisis as an obligation for all of us to do something differently.
Right.
And I think that this is also something that our visitors are considering when they make their bookings, because the carbon footprint and what your traveling would do to the environment is also something that is of consideration to a lot of people nowadays.
Right.
So I think that we have to do our part of the responsibility.
But the reality, but I guess what I'm just saying, like the reality of not pointing fingers. I mean, the reality of, we talk to vineyards all the time, right? And maybe they're shifting where they're growing because climate change has just made a reality of you can't grow here anymore. And the same thing, for you guys or for any country, right? They're looking at, okay, it's warmer. What does that mean potentially that we maybe have a longer growing season or a longer tourist season, right? I mean, it's just kind of the reality of it, unfortunately.
Yes, I understand. But but on the other hand, we really, especially politicians, we really have to be very firm when it comes, to what we really have to do in order to reverse these very negative results to the environment. So this is why I really feel that I have to make this point, and also as a minister, I have to make sure that especially tourism is really sustainable. But when we're talking about extending the season, we're not talking only about the weather and the fact that it's moderate year round. It's also that you can have these amazing experiences in Greece year round. And actually for me, I would say that especially for people who are interested in culture, it's much, much better to enjoy all these amazing sites, like 2,500-year-old sites outside the summer season. Because
I love
why would you go there, when it's 45 degrees Celsius, and not go when it's much, much nicer? And then you can also enjoy the wineries. You can also enjoy all sorts of other activities in Greece, especially also also for some people who are interested in skiing, you have to know that there are ski resorts in Greece. We are upgrading the ski facilities right now.
So good to know.
And I'm from Crete, and in Crete you could have you could ski but off piste, okay, and then you can go to the ocean.
We have to run. We have to run. Olga Kefalogianni, she is the Minister of Tourism in Greece, joining us here in studio.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.